Alright everyone, welcome back to the channel. I am buzzing today. The market is just electric. We saw that dip last week get absolutely eaten up, and Bitcoin is curling like a spring ready to launch. I'm feeling the urge, Cooper. The urge to just ape into a 100x leverage long and ride this thing to Valhalla.
And that, Murph, is precisely the emotion that separates retail traders from the capital. It's good to be excited, but trading on pure adrenaline is a one-way ticket to a liquidation notice. There's a much smarter, more sustainable way to play this.
Oh, here we go. Missed it. Spark is in the building. Don't tell me you're just sitting on the sidelines watching all this incredible price action go by.
Not at all. I'm actively participating. But instead of trying to time the market with a Hail Mary pass, I'm letting the market pay me to be here. We're not gambling, we're running a business. And today, we're going to break down the business plan. We're talking about what I genuinely believe is one of the best, most robust options trading strategies, supercharged with features specifically for crypto on the platforms where the pros play, Deribit and Delta Exchange.
Okay, that's a big claim. The best strategy. You have my undivided attention. This sounds like the kind of alpha people usually keep locked away.
It's more accessible than you think. But before we dive headfirst into this, we have to get the big, important, flashing red lights disclaimer out of the way. Nothing we say here today constitutes financial advice. We are not your financial advisors. This is purely for educational and informational purposes. Crypto derivatives are incredibly high-risk instruments. You can lose all of your invested capital and sometimes more. Please do your own research, understand the risks, and never trade with money you can't afford to lose. Start with a paper trading account. Seriously.
You heard the man. Be smart, be safe. Okay, disclaimer done. So, Cooper, set the scene for me. When people hear options and features, they either think of Wall Street guys in suits or crypto to gents getting wrecked. Bridge the gap for us. What are we actually talking about here?
Great question. Let's start with futures, because they're simpler. A futures contract is an agreement, an asterisk obligation asterisk, to buy or sell an asset at a predetermined price on a specific date in the future. In crypto, we mostly use perpetual futures, or perps, which are similar but don't have an expiration date. You can hold them, well, perpetually, as long as you maintain your margin.
Right, so that's your basic leverage long or short. If I think Bitcoin is going up from its current price of, let's say, $65,000, I can open a long futures contract. I don't need $65,000 to do it, I just need to post some collateral, some margin. And for every dollar Bitcoin goes up, my position gains value as if I owned the full coin multiplied by my leverage.
Exactly. It's a linear payoff. Simple, direct exposure to price movement. Very capital efficient for making directional bets. The risk, of course, is liquidation. If the price moves against you enough to eat through your margin, the exchange force closes your position and your collateral is gone.
We've all been there. A moment of silence for our fallen comrades. Okay, so that's futures. They amplify your directional bets. What about options? They always seemed way more complicated, with all the weird Greek names.
They are more complex, but that complexity is where the power lies. An option is a contract that gives the buyer the asterisk right asterisk, but not the asterisk obligation asterisk, to buy or sell an asset at a set price, known as the strike price, on or before a certain date, the expiration date.
Okay, hold on. Right, but not the obligation. That's the key phrase, isn't it? With a future, I'm locked in. With an option, I have a choice.
Precisely. Think of it like putting a non-refundable deposit on a house. You pay a small fee, the premium, to lock in the price. If the housing market skyrockets, you exercise your option and buy the house at the old, lower price. You made a great deal. If the market crashes, you just walk away. You lose your deposit, the premium, but you're not forced to buy an overpriced house. Your risk is capped at the premium you paid.
I like that analogy. So, in crypto, I can pay a small premium to get the right to buy Bitcoin at $70,000 next month. If Bitcoin rips to $80,000, I can use my option, buy it at $70 ask, and I'm instantly in profit. If Bitcoin stays at $65,000, I'd just let the option expire worthless. I lost the premium, but that's it.
You've just described a call option. A call gives you the right to asterisk buy asterisk. The flip side is a put option, which gives you the right to asterisk sell asterisk. You'd buy a put if you were bearish. If you have a put option with a $60,000 strike price and Bitcoin dumps to $50,000, you can exercise your option and sell your Bitcoin for $60,000, even though the market price is much lower. It's like insurance against a price drop.
Okay, buying calls if you're bullish, buying puts if you're bearish. It seems simple enough. But you're not talking about buying options, are you? Your strategy is something different.
Exactly. Buying options is a valid strategy, but it's a tough game. Options are decaying assets. Every single day, a little bit of their value, known as theta, bleeds away. To profit from buying an option, you don't just need to be right about the direction, you need to be right about the timing and the magnitude of the move enough to overcome that time decay. Most options expire worthless.
So the people who sold those options, they just collected the premium and kept it.
Now you're thinking like a professional. Instead of paying for insurance, we want to be the insurance company. We want to be the house. We're going to sell asterisk options and collect that premium, the theta decay, as our income.
Sell options, okay, that sounds risky. If I sell a call option and the price moons, what happens? Am I on the hook for infinite losses?
You would be if you were selling a naked call, meaning you sold the option without owning the underlying asset. That is extraordinarily dangerous and something no beginner should ever do. But we're not going to do that. We're going to employ one of the most foundational and powerful strategies in all of finance, the covered call.
Covered call. I've heard the term. Break it down for me, Cooper. Let's use our example. Bitcoin is at $65,000. I own 1 Bitcoin. What do I do next?
Perfect. So you have your 1 Bitcoin sitting in your wallet on Deribit or Delta Exchange. You're long-term bullish on it, but you look at the market and think, it might chop around here for a bit, or maybe go up slowly. It probably won't hit $80,000 in the next month. So you decide to generate some income from your Bitcoin while you wait.
Okay, I'm with you. My Bitcoin is just sitting there anyway. Might as well put it to work.
Exactly. You go to the options chain. Let's look at the options that expire in 1 month. You see a variety of strike prices. You decide to sell 1 Bitcoin call option with a strike price of, say, $75,000. Because you own the 1 Bitcoin to cover the potential obligation, this is a covered call.
And for selling this call option, someone pays me a premium, right? How much would that be, roughly?
It depends entirely on the market's implied volatility, but let's use a realistic example. For a 30-day option that's about 15% out of the money like this, you might collect a premium of, say, 0. 15 BTC, which at $65,000 is nearly $1,000. That premium is yours to keep instantly. It's deposited into your account, no matter what happens next.
$1,000 just for clicking a button? Okay, what's the catch? Let's walk through the scenarios. Scenario 1, Bitcoin stays below the $75,000 strike price for the next month and the option expires.
That's your best case scenario. The option expires worthless. The buyer who paid you the premium gets nothing. You keep the full $1,000, asterisk and asterisk, you still have your 1 Bitcoin, which may have appreciated from $6,500 to, say, $74,000. You made money on the premium and you made money on your spot holding. A perfect outcome. You can then turn around and sell another call for the next month. You're generating monthly yield.
I like that. A lot. Okay, scenario 2, the market tanks. Bitcoin drops to $55,000. What happens?
The option still expires worthless, of course. Nobody is going to exercise their right to buy Bitcoin from you at $75,000 when the market price is $55,000. So you keep your $1,000 premium. Now your 1 Bitcoin is worth less than when you started, for sure. You're still exposed to the downside risk of holding the asset. Watch on this is key, you are $1,000 asterisk better off asterisk than the person who was just holding Bitcoin and did nothing. That premium acts as a small cushion against the loss. It lowers your cost basis.
That makes sense. It doesn't prevent the loss, but it softens the blow. Okay, now for the big one. Scenario 3, I was wrong. The market goes on an absolute tear. Bitcoin screams past $75,000 and hits $85,000 by expiration.
This is a critical trade-off of the strategy. The buyer of your call option is going to be very happy. They will exercise their right to buy your Bitcoin at the $75,000 strike price. So, your 1 Bitcoin will be sold for $75,000.
So wait, I miss out on all the gains from 75 to 85,000. I'd be kicking myself. The FOMO would be unbearable.
You would. And this is the psychological challenge of the covered call. You're capping your upside potential in exchange for immediate, guaranteed income. But let's reframe this. You bought Bitcoin at, let's say, a low price. You held it to $65,000. You sold a call. The price went up to $75,000. You made a profit on your Bitcoin all the way up to $75 asterisk plus asterisk. You made that $1,000 premium on top. You had a concrete, profitable trade plan and you executed it perfectly. You can't be mad at a hugely profitable trade, even if you could have made more. The goal here isn't to catch every last dollar of a rally, it's to systematically generate yield.
That's a much healthier way to look at it. So, my profit is capped, but it's a very significant profit. And if I still wanted to be long Bitcoin, I could just take my $75,000 in proceeds and the premium and go buy back a little less than 1 Bitcoin at the new, higher price, and start the process again. Or wait for a dip.
Exactly. You have a defined exit and you're flush with cash. It forces discipline. You're not just diamond handing your way through volatility, you're actively managing your position.
Okay, this is starting to click. It's an income strategy. You're trading potential explosive upside for consistent, high probability yield. Now, you mentioned Deribit and Delta Exchange. Why those two specifically?
Because they are the two dominant forces in the crypto option space, but they serve slightly different purposes. Deribit is the market leader, the behemoth. It has, by far, the highest liquidity for Bitcoin and Ethereum options. This is where the institutions, the market makers, and the serious pros trade. The spreads are tight, the order book is deep. If you're trading BTC or ETH, Deribit is often considered the gold standard for its reliability and liquidity.
So if you want the best price and the ability to move size in the majors, you go to Deribit. What about Delta?
Delta Exchange has carved out a fascinating niche as the innovator and the home of all kind of options. While Deribit focuses on the top two, Delta offers options on a much wider range of assets, think Solana, Ripple, BNB, and others. They are also known for pioneering new products, like options that pay out based on the daily move of an asset, which is a pure volatility play.
So if I was a huge Solana bull and owned a bunch of SOL, I could run the same covered call strategy on Delta Exchange?
Absolutely. The liquidity might be a bit thinner than for Bitcoin on Deribit, so you have to be more careful with your order sizing and execution, but the principle is identical. You own spot SOL, you sell an out-of-the-money call option against it, and you collect the premium. Delta gives you the tools to do that with a much broader basket of crypto assets.
Okay, I see the distinction. Deribit for the deep, liquid major markets. Delta for the wider variety and innovation in altcoins. Now you mentioned supercharging this with futures. My mind immediately goes to leverage and risk. How do we combine the slow, steady covered call with the fast-paced world of futures?
This is where things get really interesting from a capital efficiency standpoint. Let's go back to our covered call example. To sell 1 Bitcoin call, you needed to have 1 Bitcoin, which is worth $65,000 sitting in your account. That's a lot of capital to tie up.
Right. Most people don't have a spare 65 grand lying around.
Correct. So what if, instead of holding 1 spot Bitcoin, you went to the futures market and opened a long position for 1 Bitcoin? To do that, you don't need $65,000. With, say, Tink's leverage, you might only need $6,500 in margin to control 1 Bitcoin's worth of exposure.
Okay, so I have a long futures position that mimics holding 1 Bitcoin, but for a fraction of the capital.
Precisely. Now, you can turn around and sell the same 1 Bitcoin call option with the $75,000 strike price against your futures position. Functionally, it's the same trade. It's a synthetic covered call. If the price stays below $75,000, you collect the premium, and your futures P&L profit and loss moves with the underlying price. If the price goes above $75,000 and the option is exercised, a long futures position will be closed out against the short call, realizing the profit up to $75 ask.
Well, so I get the same exposure, I collect the same $1,000 premium, but I only had to post $6,500 in capital instead of $65,000. That's a massive difference. My return on capital would be through the roof.
It would. The return on capital is magnified enormously. You freed up the other $58,500 to do other things, maybe run a similar strategy on Ethereum or stake it, or just keep it in reserve. This is the definition of capital efficiency.
But there has to be a catch. There's always a catch. What's the hidden risk here?
Liquidation. That's the catch, and it's a big one. With a spot covered call, if Bitcoin dumps from $65,000 to $30,000, it's painful, but you still own 1 Bitcoin. It's now just a much cheaper Bitcoin. With the synthetic version, if Bitcoin dumps, your long futures position will start to lose money. If it loses enough to eat through your $6,500 margin, your position gets liquidated. You lose your entire margin. The trade is over. You're left with nothing but the premium you collected.
Ouch. So the synthetic version using futures introduces liquidation risk, which doesn't exist if you're using spot. You're trading the security of holding the spot asset for the capital efficiency of using futures.
That is the trade-off, perfectly stated. It's a higher risk, higher reward way to run the same core strategy. It's not for everyone. If you're a conservative, long-term holder, the spot covered call is a beautiful, simple way to generate yield. If you're a more active trader, comfortable with managing leverage and liquidation prices, the synthetic version can dramatically increase your returns on capital.
So how do you decide which one to use?
It comes down to your risk tolerance, your capital base, and your outlook. If you're deeply committed to holding your Bitcoin for 10 years no matter what, you probably want to use your spot holdings. You never risk losing your stack. If you are more of a trader, looking to maximize returns over a shorter time frame and you actively manage your risk, the futures route is very compelling. You can also do a hybrid use less leverage, say only 2x or 3x, which gives you a much lower liquidation price and a greater margin of safety, while still being more capital efficient than using spot.
Okay, let's get practical here. I'm under a bit. I decided I want to sell a covered call. How do I pick the right strike price and expiration? I see options expiring tomorrow, next week, next month, next quarter, and strikes all over the place.
This is where your personal view of the market comes into play. It's part art, part science. Let's talk about the two main variables, time and price.
Expiration and strike.
Correct. Let's start with expiration. Selling shorter dated options, like weekly ones, means you collect premium more often. The rate of time decay, or theta, is highest on these short dated options. This can lead to a higher annualized yield if you keep compounding it. However, it also means you have to manage your position much more actively. Every week, you're deciding whether to roll, close, or let it expire.
More work, but potentially more reward. What about longer dated options, like 1 or 2 months out?
Selling options that are 30 to 60 days from expiration is often considered the sweet spot, especially for beginners. It's a good balance. The premiums are still substantial, but you're not chained to your screen every week. It gives the market more time to move and your thesis to play out. You sell the option, collect a premium, and can relax a bit more.
Less management headache. I like the sound of that. Okay, so let's say we settled on a 30-day expiration. Now how do we pick the strike price? We used $75,000 in our example, but what if I chose $70,000 or $90,000?
The strike price you choose is a direct reflection of how bullish you are. This is where a key concept called delta comes in. Delta is one of those Greeks, but it's the most important one to understand for this. In simple terms, the delta of an option can be thought of as the probability of that option expiring in the money.
Wait, really? The platform just tells you the probability?
Roughly, yes. So if you look at the options chain, you'll see a delta value for each strike. A strike price with a delta of 0. 20 or 20 delta has approximately a 20% chance of finishing in the money at expiration. A 50 delta option is at the money, meaning the strike price is the same as the current spot price and has a 50/50 chance.
That is an incredibly useful tool. So I can dial in my risk.
Exactly. If you're more conservative and you really don't want your Bitcoin to get called away, you would sell a low delta call, maybe a 10 or 15 delta. This would be a strike price far away from the current price, like $85,000 or $90,000. It has a low probability of being hit, but because of that, the premium you collect will also be much smaller.
Low risk, low reward. Makes sense.
Conversely, if you're more neutral or even slightly bearish and wouldn't mind selling your Bitcoin at a slightly higher price, you could sell a high delta call, like a 30 or 40 delta. This strike price will be closer to the current price, say $70,000. It has a much higher chance of getting exercised, but you will be paid a much larger premium for taking on that risk.
Higher risk of getting your coins called away, but a much fatter premium. I see. So the trade-off is between the amount of income you generate and the probability of having to sell your asset.
You've nailed it. A good starting point for many is to sell calls around the 20 to 30 delta mark. It offers a respectable premium while still giving you a good probability 70 to 80% of the option expiring worthless, letting you keep both your premium and your crypto.
This is a complete game changer. It turns buy and hold from a passive, hope-based strategy into an active, income-generating business. I feel like we need to touch on the other side of this. What if you don't own Bitcoin, but you want to? Can you use options to buy it at a discount?
You're one step ahead of me. That brings us to the other half of this strategy, which is selling puts. Specifically, cash-secured puts.
Cash secured. So I need to have the cash on hand to buy the crypto if I have to.
Precisely. Let's say you have $60,000 in stablecoins and you want to buy 1 Bitcoin, but you think the current price of $65,000 is a bit high. You'd be happy to buy it if it dropped to $60,000. So, you sell a put option with a $60,000 strike price. Someone pays you a premium for this.
Let me guess the scenarios. If Bitcoin stays above $60,000, the put expires worthless and I'd just keep the premium. My $60,000 in cash never got used and I just made free money.
Correct. You get paid to wait for the price you wanted in the first place.
And if Bitcoin does drop below $60,000, say to $58,000, the put gets exercised. I am obligated to buy 1 Bitcoin at the strike price of $60,000. My cash is used, and now I own 1 Bitcoin.
Exactly. And what is your effective purchase price? It's the $60,000 you paid minus a premium you received. So you actually bought Bitcoin for even less than your target price. This is a strategy for acquiring an asset at a discount to the current market price.
That's brilliant. So you either make income, or you buy the asset you wanted at a price you were happy with, or even better. It seems like a win-win.
It is an incredibly powerful strategy. And if you look closely, you can see how these two strategies connect. This is often called the wheel strategy. You start by selling a cash-secured put. If you get assigned, you now own the crypto. What do you do then?
You start selling covered calls on it.
Exactly. You sell puts until you get assigned the asset, then you sell calls on that asset until it gets called away. Then you take the cash and start selling put again. It's a continuous cycle of generating income from either your cash or your crypto.
The wheel. That makes so much sense. It's a complete system for interacting with the market in a methodical, non-emotional way. I have to ask, what are the biggest mistakes people make when they try this?
Number 1, as we discussed, is selling naked options. Don't do it. Number 2 is position sizing. Even though this is a relatively conservative strategy, people get greedy. They see the premiums and they sell calls against their entire stack. Then a huge rally comes, their entire position gets called away, and they are devastated by the FOMO. Start small. Sell a call against 10% or 20% of your holdings. Get a feel for it.
Don't bet the whole farm on one trade. Got it. What else?
Not understanding risk management around expiration. Let's say the price is very close to your strike price as expiration approaches. This is called pin risk. You don't know if you'll be assigned or not. It can be stressful. A good practice is to manage the position before expiration. If you've already made 80% or 90% of the potential premium, it's often wise to just buy the option back for a small cost, close the trade, and lock in your profit. Don't be greedy for that last 10%.
Take profits and move on. Don't let a winning trade turn into a headache.
Precisely. The goal is consistent, stress-free income, not squeezing every last cent out of every trade. And finally, people get caught off guard by volatility. The premiums you collect are directly related to implied volatility. In high volatility markets, you'll get paid huge premiums. In low volatility markets, the premiums will be much smaller. You have to adapt your expectations. But the great thing about this strategy is that it profits from high volatility, which is usually a scary thing for crypto investors. When everyone else is panicking because the market is swinging wildly, you're actually able to sell options for much juicier premiums.
So you're essentially selling peace of mind to panic traders. Man, this really reframes everything. It's not about predicting the future. It's about selling probabilities and collecting income for taking on a defined risk. Whether you're using your spot on Deribit for security or using futures on Delta for capital efficiency with altcoins, the core logic is the same.
That's the entire philosophy. You stop being a price speculator and you become an insurance provider. You analyze the market, you form a thesis: I think Bitcoin is unlikely to go above X price in the next Y days, and then you sell an option that reflects that thesis and get paid for it. It's an intelligent, accessible, and repeatable process.
Incredible. I feel like my brain has been upgraded. So for everyone listening, the key takeaway is this: you can turn your idle crypto into an income-generating asset by selling covered calls. You cap your upside for guaranteed, immediate premium. You can use platforms like Deribit for BTC and ETH, or Delta for a wider range of alts. And if you're comfortable with the risk, you can use futures to do it with much less capital.
A perfect summary, Murph. Final piece of advice is just to learn. Both Deribit and Delta have paper trading accounts. Use them. Place these trades with fake money. Watch how the P&L changes. See what happens at expiration. Get comfortable with the mechanics before you ever risk a single real dollar. This is a professional strategy, and it deserves a professional approach to learning.
Absolutely. Well, Cooper, this has been a masterclass. I think we've given people a genuinely powerful blueprint here. Forget aping into 100x funds, this is how you build sustainable wealth in crypto.
That's the goal. Slow and steady, but with a powerful engine under the hood. It's about lasting in the market long enough for your long-term bullish thesis to play out and getting paid while you wait.
I love it. Alright everyone, let us know what you think in the comments. Have you ever tried selling options? Are you a Deribit loyalist or a Delta degen? We want to hear from you. And of course, if you found this valuable, hit that subscribe button because we're going to be diving even deeper in future episodes. Thanks for tuning in.
Thanks everyone. Trade smart.